What if I told you that you've been learning about compounding the wrong way your entire life? Would you believe me? Well, most of you might think that I'm just not telling the truth, or that I'm saying these things just to get views on the video. But friends, I am telling the truth. Truly smart people are always staying one step ahead of us. They don't just do compounding. They play double compounding, whether the market is up, sideways, or has fallen. These people compound their money in every single situation. And no, I am not talking about SIP versus lump sum. I'm talking about such a fantastic secret strategy that even the ultra rich people of the world actually use to multiply their money many-fold. And they do it so fast that an average investor truly cannot even imagine it. These people don't just compound their money once, but they actually compound it twice, a secret process known as double compounding. Often, we simply invest our money and then wait patiently for the market to go up to get some returns. However, frequently the market does not move upward for many long months, and it takes a long time to see any returns. Even mutual funds start giving negative returns. Then after 2 or 3 years, the market finally goes up and only then some returns are generated. This is a slow and steady growth curve, which I call single compounding, where you consistently invest your money and watch it steadily accumulate value over a long period. However, a fundamental problem exists with this line of thinking because this strategy does not unleash the full potential of your money. It is exactly like owning a powerful V8 engine, but you are only actually using 2 of its cylinders to get anywhere at all. Or consider having a high-speed 5G internet connection while still using a mobile with 2G speed. Now, simply imagine what would occur if you finally activated all of the cylinders inside your personal investment engine. So what exactly would happen if you finally switched from 2G to 5G speed? For instance, a 5GB file that took 30 minutes to download at 2G speed would finish downloading in just 10 minutes at 5G speed. Compounding is quite similar. The total wealth that would be created in 30 years through single compounding can actually be created in just 10 to 15 years through double compounding. To understand this double compounding system with much greater detail, please be sure to watch this entire video through to the end. There are 2 separate systems. I'll explain you the entire system with complete practical calculations and examples. See, whenever you happen to receive a lump sum amount, like 1, 2, 5 or 10 lakh, or any such amount, your FD matured, or you got money from selling land in your village. Or maybe you have just received a commission from a big deal, or perhaps you received a Diwali bonus. What do you actually do with that money? You see, what typically happens is that most Indians put their money into traditional options. But for past 1 year, the market has gone sideways. In such a scenario, many investors' portfolios haven't reached their expected growth. Even for those who are doing SIPs, results are largely stagnant too. In fact, I personally have several close friends who have already started their SIPs, but they couldn't generate the returns they had hoped for. For example, look at this. An individual recently shared a screenshot regarding their own 2-year SIP portfolio on Reddit. He invests 35,000 rupees monthly via SIP. In 2 years, a total of around 5,66,000 rupees has been invested. The value is now 5,73,093 rupees. This means that for 2 years, every single month, investing 35,000 through SIP yielded just a profit of 6,238 rupees. Despite investing continuously for 2 years, his portfolio is still showing only a limited profit. Here's a screenshot of another investor's portfolio. An investment of 2,15,000 and the current value is 1,67,000 rupees. That's a loss of about 48,000 rupees, and that too in just 1 year. Now this person is asking on Reddit, seeking advice on whether he should hold or exit, and I do not know about you, but this is what happens with many retail investors. They enter the market when it's at a high phase, and then their personal portfolio doesn't seem to recover nearly as quickly. But if you choose to follow the double compounding system, it allows you to make your overall investment journey much more stable while becoming far more predictable over time. The system is simple. Whenever you happen to receive a lump sum amount, you can easily allocate it across several different investment options. One of those primary investment options includes bonds and debentures, which provide 9 to 12% annual interest. Here, you can receive monthly interest. It really won't matter to you whether the market is up or down. If you invest 1 lakh rupees, then at 12%, you will earn an interest of approximately 1,000 rupees credited directly into your bank account every single month. And it's not necessary to have 1 lakh rupees to start. Yes, you can start investing in bonds with just 1,000 rupees. Even if the interest is just 10 rupees, the company is guaranteed to honestly credit that amount to your bank account because every one of the bonds currently listed are in fact all bonds with very strong credit ratings. Every bond issuer undergoes a quarterly audit. Full due diligence is also conducted. They really do not just list any company's bonds on the platform. These bonds are listed on the exchange So you also get liquidity if you need money in between. So you can sell the bonds or debentures directly from their website. And the best part is that the entire investing process is completely seamless. Be it UPI or net banking, it gets done in just a few minutes. You also get access to a powerful dashboard where you can track all of your investments easily. You can also easily view the full repayment schedule and even choose to reinvest automatically. Now, the interest money that you receive every month, don't go about spending it. Invest it every month in a good equity mutual fund through an SIP. What this does is your lump sum amount gets invested in a bond. So from the very next day, you'll start earning 12% interest. In bonds and debentures, you receive a fixed interest. This is exactly why you will get a very predictable cash flow every month. In the stock market, returns can often be volatile, but the actual interest you earn from bonds is fixed. This really helps you to create a balance in your portfolio. Let's say you were to invest around 1 lakh rupees in a bond, which has quite a strong credit rating. Now, at 12%, an interest of approximately 1000 rupees will be credited directly to your bank account every month. And furthermore, with that money, every month. Start an SIP of 1000 rupees in an equity mutual fund. After 30 years, a corpus of about 70 lakh rupees will be created, assuming a 15% per annum return in that SIP. And the best part is that you're starting all this with just 1 lakh rupees. You're not investing a single rupee from your own pocket over the entire 30 years. All you have to do is simply reinvest the interest that you receive every single month into that SIP. That is it. Now, let us consider the specific person on Reddit who invested 2,15,000 rupees directly into equity and was then facing a loss of 48,000 rupees. Had he simply chosen to diversify his money and kept a decent portion in safe bonds, he would have received a monthly interest of approximately 2,150 rupees, which would have made his total portfolio a bit more balanced. And then, if he wished, he could have also invested that same amount in the market as a monthly SIP. After 30 years, due to compounding, that money could have grown to over 1.5 crore rupees. Again, assuming a 15% per annum return. This means the same money is working in two places at once. On one hand, you are earning a fixed interest, and on the other, you're getting some great long-term growth. But when you actually try to execute this system, you will face three major problems. The problem number one is bond maturity. You get the opportunity to invest in bonds with tenures ranging from 6 months to 3 years. Until maturity, you will keep receiving regular interest every month. Upon maturity, your invested amount, which is the principal amount, will be returned in full directly to your bank account. Now, with that money that you have received, you'll have to identify new bonds and reinvest that money in them. If you forget and the money just sits in your bank account, compounding will stop. Thankfully, these dedicated people won't let that happen. What happens is that whenever your bonds mature, they will immediately and proactively help you reinvest all of your money into the top performing bonds available on the market at that time so that your compounding doesn't break. The second biggest problem is the disappearance of the interest money. Look, the bond issuing company will credit the interest to your bank account every month because this process is regulated. However, if you ever happen to forget about it and end up using that money elsewhere, your monthly SIP will definitely bounce. The bank will levy charges and your compounding will break. As per the official bank rules, if 3 consecutive SIP installments bounce, the SIP is stopped. The solution is quite simple. Maintain a dedicated bank account in order to operate this entire automated system. By doing this, you will definitely never encounter this specific problem. Now, our third and final major problem is that you simply do not have a large amount like 1 or 2 lakh rupees to invest. Don't worry, there's a solution. See, earlier, such bonds were only available to large institutions. Earlier, the minimum face value was 10 lakh rupees. But now, this access has been opened up for retail investors as well. It is now possible to start investing with merely 1000 rupees. The interest might be small, but at least get started. Understand the process once. Since you have less money, the risk is also lower. And as you get more money, you will be able to keep investing more in bonds and debentures. As your investment amount continues to grow, your monthly interest income will surely also keep increasing. Let me explain another exceptionally smart trick. Simply use your interest income to invest in even more bonds for yourself. By starting with just 10 or 20,000, you can build a portfolio worth lakhs. Look at this table on the screen. Suppose you decide to start with just 25,000. At a rate of 12%, you will get an interest of approximately 250 rupees every month. In 4 months, that is 1,000, and in 12 months, it is 3,000. Next year, invest this money in bonds too. Your monthly interest will increase to 280 rupees. Next year, that hits 314, followed by 351 rupees. Following a period of 30 years, your projected monthly interest income will reach 7,500 rupees, and a bond portfolio worth 7.5 lakh rupees. Beginning this journey with a capital of 1 lakh rupees. Then after 30 years, your monthly interest income. will be 30,000 rupees and your bond portfolio will be around 30 lakh rupees. That's the power of compounding. Sorry, double compounding. Creating a layer where our principal invested money earns interest, plus a secondary layer where that earned interest is also continuously reinvested and accumulates much more interest. I have included a direct link to this spreadsheet for you in the description. You can download it, input your specific investment value and interest rate, and review the calculations to see how substantial your corpus could become after 30 years, and how much monthly income you'll get. Rich people have many more strategies like this, some of which I have also explained in this video. How exactly wealthy individuals multiply their total wealth, how they always manage to stay one step ahead of us, and precisely where they invest their money. Everything is covered. In this video, I have even explained how to invest in premium real estate properties with just 500 rupees, and how you can earn regular rent and capital appreciation too. I have conveniently put the direct links to both these helpful videos in the description below and on the end screen. Be sure to check them out after this video ends. And if you really want to take your wealth to the next level, now is the perfect time to start the double compounding strategy. Whether the amount is small or large, 1 lakh or 1000, sign up using the link in the description and get started. Finally, remember one thing: the difference between a wealthy person and an average person isn't just income. The real difference is simply in how they choose to put their money to work and how they actually grow that money. If you have truly understood this strategy, please like the video. Share it with all your friends as well. And for more interesting videos like this, subscribe to the channel. Jai Hind.